Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now, let's break down what's happening in the markets today in a clear and simple way.
Yeah, and today we've got a really critical one to dig into.
We absolutely do. So I want you to imagine that your household emergency fund is just completely drained.
Right, sitting at zero.
Exactly. And your personal credit cards are maxed out right to the absolute limit. And then, out of nowhere, your car's transmission just completely breaks down.
Oh man, the worst timing.
Right. You need cash fast, but the bank looks at your accounts and says, sorry, no more credit for you.
That is a terrifying feeling.
It's that sinking, horrible feeling in your stomach, and that is exactly where major European economies find themselves right now.
They really do.
Today, we are looking at a massive financial reality check that is hitting Europe. Specifically, we're doing a deep dive into the concept of sovereign debt.
Which sounds complicated, but it's really not.
Right. For anyone new to the term, sovereign debt is really just a Wall Street phrase for a country's national credit card balance.
Exactly.
It's the money a government borrows from global investors to keep the lights on when, tax revenues just aren't enough to cover the bills.
And the broader context for why this is so critical for you to understand right now is that Europe is basically staring down the barrel of another major energy shock.
Yeah, and the landscape is totally different this time around.
It's shifted completely. I mean, a few years ago when global energy prices spiked, governments across the UK and France, they just swiped that national credit card.
They didn't even hesitate.
Right. They borrowed billions to subsidize heating costs and, protect their citizens from the financial blow. But today, they were discovering those national credit cards are effectively maxed out.
Declined.
Exactly. We are entering this phase where high existing debt loads combined with surging interest rates are actively paralyzing some of the largest economies in the world.
And understanding the mechanics of how this paralysis happens, it's essential for figuring out how to protect your own everyday investments.
Absolutely.
So to really grasp the severity of this shift, we have to look at the stark difference between the crisis of 2022 and the situation today.
Right. It's night and day.
It is. It all boils down to a concept economists call fiscal capacity.
Which is such an important term.
Yeah, so think of fiscal capacity as like the buffer zone. It's the amount of money a government can safely borrow and inject into the economy without causing its currency to collapse or triggering runaway inflation.
And when you measure that buffer zone based on the recent analysis, the contrast is just staggering.
Oh, it really is.
During the 2022 to 2023 energy crisis, Eurozone governments deployed this massive financial safety net. I mean, the data shows they spent roughly 3.6% of their total gross domestic product, or GDP, on energy support packages.
Which is huge.
For citizens and businesses, yeah. To put that in perspective for you, 3.6% of a national economy is an astronomical amount of money to mobilize for just a single issue.
Right. It was basically a blank check approach to keeping the economy afloat. It's universal. Like, your heating bill doubled, here's a government check, gas prices skyrocketing, we'll just subsidize the cost at the pump.
Yep.
But the reality of borrowing that much money is that eventually the bill comes due.
And the bill is arriving right now.
Yeah.
The baseline scenario, modeled for today, indicates that these exact same governments can only afford to spend about 0.3 to 0.6% of their GDP on new support.
Wait, from 3.6 down to 0.3?
Down to 0.3, yeah. The buffer zone is completely evaporated.
Wow.
European Union fiscal rules have tightened back up, and borrowing money is, exponentially more expensive today than it was in 2022.
Right, because of interest rates.
Exactly. So governments are now restricted to very small, highly targeted interventions. The whole era of throwing a blanket of cash over the entire population, that is officially over.
I mean, I see this divergence happening across the continent, too. It is essentially a real-time stress test, of who managed their national budget responsibly over the last decade and who didn't.
Oh, for sure.
Because in France and the UK, politicians are facing immense public anger over energy costs, right? Yet they are flat out refusing broad fuel tax cuts.
Because they simply cannot afford the loss of tax revenue.
Exactly. But then you look at Germany. Historically, Germany has maintained a much stronger budget discipline.
Right, much lower overall debt levels.
Right, and because they didn't max out their card entirely, they actually had the fiscal capacity to announce a 1.6 billion euro temporary fuel tax relief package just in mid-April.
Which is wild. The German response really highlights how critical fiscal stamina is.
Yeah.
When an external shock hits an entire region equally, the country with the strongest balance sheet basically gets to dictate its own recovery.
While everyone else is just at the mercy of the bond markets.
Exactly. And France is currently one of the most sensitive fiscal cases in Europe right now.
Why is that?
Well, because they are caught in this mathematical trap where high borrowing costs are literally neutralizing their economic output.
Okay, unpack that a little bit.
So, looking at the projections from France's official statistics agency, their budget deficit for 2025 is projected at 5.1% of their GDP.
Okay, wait, let me just break those terms down really quick for you listening because, they get thrown around a lot.
Yeah, please do.
The deficit is the shortfall for just one single year. It's how much extra the French government is spending this year compared to what they actually collect in taxes.
Right.
The total national debt, on the other hand, is the giant accumulated mountain of all those past yearly deficits stacked on top of each other.
And that accumulated mountain of debt for France, it is now sitting at 115.6% of their GDP.
Wow.
Uh.
Over 100%.
Meaning, yeah, they owe significantly more money than their entire country produces in a single year.
That is insane.
And this becomes a major structural problem because the European Union has this foundational rule that member countries should not run deficits larger than 3% of their GDP.
Right, the 3% rule.
Yeah, the shared euro currency relies on all member nations maintaining relatively healthy budgets.
Yeah.
So France is desperately trying to wrestle its deficit back down to that 3% target by 2029.
But I imagine the current energy environment makes that an incredibly steep uphill battle.
To say the least.
Well, I want to push back on the math here for a second, actually, because a very logical question arises for anyone looking at this.
Okay, what is it?
If global energy prices are going up and everyday gas is more expensive at the pump, doesn't the French government actually collect more money?
Ah, right.
Because fuel taxes are often calculated as a percentage, right? So if the price of the commodity goes up, the tax revenue should go up too.
You would think so.
Shouldn't that unexpected windfall of extra cash actually help them pay down their deficit?
It's a great question. And on paper, higher prices do generate slightly more tax revenue. But that logic completely misses the hidden, devastating cost of inflation.
The interest rates.
Exactly. France's budget minister recently addressed this exact paradox. The rising cost of energy drives up general inflation, right?
Right.
And to fight that inflation, central banks have to keep interest rates elevated. Because France has such a massive mountain of accumulated debt, those higher interest rates mean the cost of servicing their debt, just paying the interest to bondholders, it skyrockets.
Wow.
So the extra billions they have to pay in interest completely erase any minor bump they get in fuel tax revenue.
Okay, I get it. It is the ultimate middle-class trap, but just on a national scale.
How do you mean?
It's like imagine you finally negotiate a $500 a month raise at your job rate.
Okay.
You feel great. You think you finally have some breathing room to pay off your credit cards, but at the exact same moment, your adjustable rate home mortgage resets to a modern interest rate, and your monthly housing payment jumps by $500.
Oh, that's brutal.
You are technically earning more money on your paycheck, but your bank account is just as depleted, if not more so.
That is a perfect analogy. The profits are entirely swallowed by the interest payments.
It's so frustrating.
The government has to funnel a massive portion of its budget away from public services and just hand it directly to creditors.
Wow.
Now, France isn't facing an immediate overnight default. This isn't a situation where the government just shuts down tomorrow.
Right, they have tools.
They do, but their policy options are incredibly constrained. They cannot stimulate the economy with cash, so they are being forced to pivot their entire long-term strategy.
Yeah, I mean, if I am the French finance minister, I am looking at a board with very few moves.
Exactly.
I can't borrow more without spiking my interest rates further, and I can't print my own money because I am part of the Eurozone.
Right, you don't control the currency.
I have to find a way to stop the bleeding without spending any new cash.
Which is exactly why France just announced this massive 10 billion euro a year electrification plan stretching out to 2030.
Oh, right.
Yeah. The objective is to aggressively cut their reliance on imported oil and gas, insulating themselves from future energy shocks.
That makes sense.
But the defining feature of this plan is that they committed to doing it with, quote, no new money.
Oof. No new money is the most painful phrase in government.
It really is.
It means they aren't issuing new bonds to pay for these power grid upgrades.
Right.
To find 10 billion euros a year, they actively have to defund other areas of the government. They have to pull money away from transportation or education or healthcare just to fund energy independence.
And that is the textbook definition of a fiscal squeeze.
Absolutely.
And, while France is battling its EU debt limits, the situation across the English Channel in the UK is creating an entirely different kind of economic storm.
Oh, the UK.
Yeah, one that is actually dictating their foreign policy.
Seriously. Okay, tell me about that.
So the UK serves as a textbook example of how weak public finances leave a country hyper-vulnerable to global inflation. Looking at the data from the Office for Budget Responsibility, UK government borrowing is projected to hit 4.3% in the 2025 to 2026 period.
Which is well over that 3% ideal we talked about.
Exactly. And their total debt is steadily climbing, projected to hit near 94.5% by the end of the decade.
That's getting close to France levels.
It is. Now, the government officially claims they have about £24 billion in, quote, headroom.
Headroom.
Which is essentially spare cash or wiggle room in the budget to handle emergencies.
Okay, whenever a heavily indebted entity claims to have plenty of wiggle room, it usually warrants a closer look.
Oh, definitely.
That headroom is usually based on incredibly optimistic economic forecasts that can just vanish the second the wind changes direction.
And the vulnerability of that headroom was exposed brutally in February.
What happened in February?
In that single month alone, the UK's interest payments on its national debt skyrocketed to £13 billion.
13 billion.
In 1 month. In 1 month. To provide context, in the exact same month the previous year, the interest payment was £7.5 billion.
Oh my gosh. So 13 billion pounds just vanishing in a single month.
Poof, gone.
That money isn't building high-speed rail lines, it isn't funding the National Health Service, and it isn't paying teachers. It is just the penalty fee for past borrowing.
Yep.
When your monthly interest payments are jumping by billions of pounds unexpectedly, your 24 billion pound headroom is nothing but a mirage.
It's completely wiped out.
And this domestic financial fragility actually explains a really interesting geopolitical dynamic.
How so?
Well, recent analysis noted that the UK moves significantly faster than the United States to release their strategic oil reserves and seek international coordination the moment this energy shock hit.
Right, it exposes a fundamental difference in economic resilience between the two nations.
Yeah, if you look at the United States context, under President Trump, we have massive domestic energy production. We are a major exporter.
Right, the U.S. has that buffer.
Exactly. When the U.S. decides to release barrels from the strategic oil reserves, it is often used as a calculated economic lever to manage global prices or secure trade advantages.
That's strategic.
Right. But for the UK, they are almost entirely reliant on the global market. They do not have the luxury of treating an energy spike as a distant foreign policy issue.
No, it's immediate.
Because their national debt is so high, an energy shock immediately threatens to blow up their domestic budget. They have to stop the bleeding instantly because they absolutely cannot afford the inflation and the subsequent interest rate hikes that follow expensive oil.
And the economic term for the nightmare scenario the UK is fighting off is a stagflation trap.
Stagflation, I've heard that.
Yeah, stagflation basically breaks the traditional rules of economics.
Right.
Normally, if an economy is stagnant or shrinking, prices fall because consumer demand dries up, right?
That makes sense.
But stagflation is a stagnant, slowing economy combined with high inflation. Businesses are struggling, yet the cost of everything just keeps rising.
That's the worst of both worlds.
It really is.
Yeah.
UK businesses are currently anticipating 3.7% inflation over the next year, and a significant portion of them are signaling they will likely cut jobs to survive the squeeze.
So you have citizens losing their jobs while the cost of their groceries and heating bills continues to climb.
Exactly.
That puts the central bank in an impossible, agonizing position.
The Bank of England is facing intense pressure from the markets to hike interest rates as early as April, just to tame that 3.7% inflation.
Right. You have to cool the inflation.
But if they don't hike rates, the cost of living spirals completely out of control.
Okay, but
if they do hike rates to cool inflation, they intentionally make borrowing even more expensive for businesses that are already laying people off.
oh man.
They risk choking whatever tiny bit of economic growth is left while simultaneously driving up the government's own debt servicing costs even further.
It is a vicious cycle of low growth and high interest rates.
It really is.
And if you are an everyday investor listening to this entire situation demands that you fundamentally rethink how you protect your money.
You have to.
For decades, the conventional wisdom was simple. If the stock market looks scary, you buy government bonds from major developed nations like the UK or France.
Right.
You park your money in sovereign debt because it is supposed to be the ultimate guaranteed safety net.
But we are actively watching the redefinition of what a safe investment actually is.
The rules are changing.
They really are.
Oh.
The global bond market is experiencing severe pain because investors are waking up to this new reality.
What does the data show on that?
Well, the FTSE World Government Bond Index, which tracks the performance of sovereign debt globally, it dropped over 3% in March alone.
Wow.
In the world of government bonds, a 3% drop in a single month is massive.
Yeah, bonds aren't supposed to be that volatile.
Exactly. It's the biggest monthly decline in a year and a half. Markets are adjusting to the reality that high inflation and high interest rates are going to stick around for a long time.
You know, it feels very reminiscent of the 1970s.
Oh, absolutely.
We aren't looking at a sudden self-inflicted policy disaster. A few years ago, the UK experienced that infamous Liz Truss mini-budget crisis, where a poorly planned tax announcement caused the bond market to crash overnight.
Right, that was a sudden cliff edge.
Yeah. But this current crisis is an external structural energy shock hitting governments that already have weakened immune systems.
The 1970s perfect storm comparison is incredibly apt.
Yeah.
Back then, it was an Arab oil embargo. Today, it is geopolitical conflict and a structural shift in energy supply chains. But the mechanism is identical.
Right.
Central banks cannot print more oil. They cannot fix the supply-side energy shock simply by tweaking interest rates.
No, they can't.
As the shock lingers, the high borrowing costs slowly and methodically grind the entire economy down.
Okay, so if the traditional safe havens are grinding down, we need to talk about the very real danger of duration risk.
Yes, duration risk is huge right now.
Buying long-term European bonds right now is incredibly dangerous. The easiest way to conceptualize duration risk is to imagine taking your hard-earned savings and locking it into a 10-year certificate of deposit, a CD, at your local bank.
Okay.
Say it's paying a fixed 3% a year. You feel secure, right?
Sure. 3% guaranteed.
Right. But the next month, national inflation shoots up to 6%.
Oh, no.
Suddenly, your 3% return means you're actually losing purchasing power every single day.
Because things cost 6% more.
Exactly. To make matters worse, you find out the bank holding your money is deeply in debt and mismanaging its funds.
That's terrifying.
Your money is locked behind glass for a decade, losing value in real terms, while the institution holding it looks shakier by the minute. You have taken on all the risk of tying up your capital, but you are generating zero actual profit.
It is profitless risk.
Exactly.
And that mechanism is exactly what plays out when an investor buys a 10-year or 20-year government bond from a heavily indebted country during an inflation spike.
Yeah.
You are locking in a nominal return that will be eaten alive by inflation, while watching the underlying fiscal health of the country deteriorate.
So, if the old playbook is completely obsolete, what are the actionable takeaways here? Where should you be looking to allocate capital if the giants of Europe are struggling to carry their own weight?
The primary takeaway from the current market analysis is that investors must stop lumping all of Europe into one homogeneous bucket.
You can't just buy Europe.
Exactly. High debt, long-term bonds from the UK and long-term bonds from France are both highly risky right now, albeit for different structural reasons.
Right.
France is constrained by massive debt limits and inflexible EU regulations, while the UK is being actively squeezed by stagflation and urgent monetary policy pressures.
So the move is to completely avoid the long-term debt of these struggling giants.
Yes.
What steps into the void as the new safe asset then?
The new safe assets are significantly more defensive and adaptable. The capital flow is pointing heavily toward short-term government bonds.
Okay, short-term.
By keeping the duration short, your money isn't locked up for a decade, allowing you to reinvest at higher rates if inflation persists.
That makes total sense.
Simply holding higher cash reserves is also a viable defensive strategy right now.
Cash is king.
It really is in this environment. Also, inflation-linked bonds, which are specifically designed to automatically increase their payouts as consumer prices rise, those are incredibly attractive right now.
Oh, absolutely.
And finally, there is a major pivot toward equities in sectors that directly benefit from this crisis.
Like what?
Specifically, companies involved in energy independence, modernizing the power grid, and broad electrification.
It always comes back to following the money.
Always.
If governments are backed into a corner and forced to spend their last remaining tax dollars on securing energy independence, like France's 10 billion euro no new money pivot we talked about, that is exactly where the guaranteed growth will be.
Right.
You invest in the absolute necessities that a country simply cannot survive without.
Adapting to this market requires accepting the reality that the sovereign fiscal safety net has massive irreparable holes in it. The government simply cannot catch the falling knife for you anymore.
It is a profound shift. Let's just recap the journey we've been on today.
Sure.
The era of governments printing massive bailouts and writing blank checks for every crisis is officially in the rearview mirror.
It's gone.
The national credit cards are maxed out and the interest payments are coming due. Today, a country's economic survival depends entirely on its fiscal stamina, how much buffer zone they preserved before the crisis hit.
Yep.
And right now, massive economies like the UK and France are running out of breath, trapped in a vice between sticky inflation and crippling interest payments that erase their tax revenues.
It is a sobering reality, but understanding these underlying mechanics gives you a massive advantage in protecting your portfolio.
It really does.
But before we wrap up today's analysis, there is one final critical warning from the bond markets that you need to keep on your radar.
Okay, what's that?
Throughout this discussion, we focused heavily on the structural struggles in the UK and France. But the bond markets are currently flashing bright red for Italy.
Italy? Really?
Yes. In fact, their government bonds, known as BTPs, are under even heavier pressure and scrutiny than France or the UK due to their uniquely massive debt pile.
Wow.
So I want you to ponder this as you look at the global markets this week.
Okay.
If the financial firefighters in France and the UK are already completely out of water, what happens to the stability of the global economy if Italy's debt catches fire next?
That is a terrifying but incredibly important geopolitical question to keep an eye on as we move forward. Don't forget to subscribe and hit that like button.